Bill Ackman. The only three investments I'd make before 2027, if I had to put every dollar I own into just three investments for the next 2 years. I would not hesitate. I would not need to consult my team. I would not need to run more analysis. Because after spending over 2 decades managing billions of dollars through every market cycle imaginable, I have learned exactly what separates investments that protect and grow wealth from investments that destroy it. And right now, heading into 2027, there are only 3 investments I would make with complete confidence. Let me tell you why this matters so much right now. We are entering one of the most uncertain periods I have seen in my career. Inflation has fundamentally changed the investment landscape. Interest rates have normalized after a decade of artificial suppression. Geopolitical tensions are creating risks that did not exist 5 years ago. The artificial intelligence revolution is disrupting industries at a pace that makes the internet boom look slow. And through all of this uncertainty, most investors are paralyzed. They do not know what to do. They are sitting in cash earning 4% while inflation erodes their purchasing power, or they are chasing whatever stock is making headlines this week, lurching from one hot idea to the next without any coherent strategy. That is not how you build wealth. That is how you destroy it. Building wealth requires conviction. It requires understanding what you own and why you own it. It requires the discipline to ignore the noise and focus on fundamentals. And most importantly, it requires identifying the small number of investments that have asymmetric risk-reward profiles, where the upside dramatically exceeds the downside. I have spent my entire career looking for these asymmetric opportunities. I have made billions of dollars by concentrating capital in my highest conviction ideas and having the patience to let them play out. And today, I am going to share the 3 investments that I believe offer the most compelling risk-reward profiles heading into 2027. Before I reveal these 3 investments, let me explain the framework I use to evaluate opportunities. Because understanding the framework is more valuable than just knowing the names. If you understand how I think, you can apply this approach to any investment decision you face. The first thing I look for is quality. I want to own businesses that have durable competitive advantages, that generate high returns on invested capital, that are run by excellent management teams with aligned incentives. Quality businesses compound wealth over time because they can reinvest their profits at attractive rates of return. They can raise prices without losing customers. They can weather economic downturns without existential risk. Quality is the foundation of everything I do. The second thing I look for is value. Even the best business in the world is a bad investment if you pay too much for it. I want to buy quality businesses at prices that offer a margin of safety. I want the current valuation to assume relatively modest outcomes so that I make money even if things only go okay, and I make a lot of money if things go well. Buying at attractive valuations also limits my downside. If I pay a fair price for a great business, the stock might go down temporarily, but it is unlikely to stay down permanently. The third thing I look for is a catalyst. This is what separates good investments from great investments. A catalyst is something that will cause the market to recognize the value I see within a reasonable time frame. It could be an operational improvement, a strategic change, a macroeconomic shift, or simply the passage of time as earnings grow and valuations expand. Without a catalyst, I might be right about the value but wrong about the timing, and in investing, being early and being wrong often feel the same. When I find an investment that combines quality, value, and a catalyst, I invest aggressively. These opportunities are rare. Maybe I find 5 or 10 per year that truly meet my criteria. But when I find them, I concentrate capital and let the thesis play out. This approach has generated exceptional returns over my career, and I believe it will continue to do so. Now let me share the 3 investments I would make heading into 2027. The first investment is large cap quality stocks with pricing power. Let me explain exactly what I mean and why this is so compelling right now. We have just lived through the most aggressive interest rate hiking cycle in 40 years. The Federal Reserve raised rates from essentially 0 to over 5% in less than 2 years. This created massive dislocations across financial markets. Growth stocks got crushed as the present value of their future cash flows declined. Speculative investments collapsed. Risk assets broadly sold off. But something interesting happened amid all this carnage. The highest quality companies, the ones with dominant market positions and pricing power, held up remarkably well. They raised prices to offset inflation. They maintained or even expanded their profit margins. They continued to grow earnings while lesser competitors struggled. This tells me something important. In an inflationary environment, quality matters more than ever. Companies that can raise prices without losing customers are worth far more than companies that cannot. And we are still in an inflationary environment. Yes, inflation has come down from its peak, but it remains elevated above historical norms. And the structural forces that drove inflation higher, including deglobalization, underinvestment in commodities, aging demographics, and massive fiscal deficits, have not gone away. I believe we are in a new regime where inflation runs hotter than it did in the 2010s. And in that regime, owning companies with pricing power is essential. Let me give you some specific examples of what I mean. Think about a company that owns one of the most recognized brands in the world, a brand that consumers have trusted for decades, a brand that has become so embedded in daily life that most people cannot imagine switching to an alternative. That company can raise prices 3, 4, 5% per year and customers will keep buying. The price increases flow directly to the bottom line because the costs do not rise as fast as the prices. Profit margins expand, earnings grow faster than revenues. The stock compounds. Or think about a company that provides essential services to businesses. Services that are deeply integrated into their customers' operations. Services that would be painful and risky to switch away from. That company has pricing power because the switching costs are so high. Customers might grumble about price increases, but they pay them because the alternative is worse. Again, the pricing power translates directly into earnings growth that compounds over time. The specific companies that fit this profile include dominant consumer brands, infrastructure businesses with regulatory moats, software companies with high switching costs, and healthcare businesses with patent-protected products. These are not exciting stories. They do not make headlines. They do not promise to change the world. But they reliably grow earnings at double-digit rates year after year, and they trade at valuations that are reasonable given their quality and growth. Why do I think this is particularly compelling heading into 2027? Because interest rates have stabilized and are likely to decline modestly over the next 2 years. As rates come down, the valuations on quality growth stocks should expand. You get a double benefit. Earnings continue to grow from the operational excellence of these businesses, and the multiple the market is willing to pay for those earnings increases. This is how you generate 20, 30, even 40% returns over 2 years without taking excessive risk. The key is being selective. Not every large cap stock has pricing power. Not every well-known company has a durable competitive advantage. You have to do the work to identify the businesses that truly have something special. You have to analyze the competitive dynamics, the customer relationships, the barriers to entry, and you have to be disciplined about valuation. Even quality companies can become overvalued, and overpaying destroys returns. I have spent months analyzing which companies have the strongest pricing power, the most durable competitive positions, and the most attractive valuations. I have built positions in a concentrated portfolio of these names, and I believe they will deliver exceptional returns over the next 2 years as the market recognizes their quality and the interest rate headwind fades. The second investment I would make heading into 2027 is high-quality real estate at distressed valuations. I have already talked extensively about real estate, but let me explain why it deserves to be one of only 3 investments I would make right now. The opportunity is that compelling. Real estate investment trusts have been absolutely crushed over the past 2 years. The combination of rising interest rates and fears about commercial real estate has driven REIT stocks down 30, 40, even 50% from their peaks. The sentiment could not be worse. Every headline screams about office vacancies, regional bank failures, and commercial real estate collapse. Investors have fled the sector entirely. But here is what the headlines miss. Not all real estate is the same. Office buildings in declining markets with short-term leases to struggling tenants are indeed troubled. But industrial properties near major transportation hubs with long-term leases to e-commerce giants are thriving. Data centers that house the computing infrastructure for artificial intelligence are seeing demand growth of 30% per year. Healthcare facilities serving the aging baby boom generation have predictable, growing demand for decades. Apartment buildings in supply-constrained markets with strong job growth are raising rents every year. The market has painted all real estate with the same brush. It has sold the good with the bad. It has created an opportunity to buy the best real estate in the world at prices that make no sense, given the underlying fundamentals. Let me give you some numbers. I have been analyzing REITs that own portfolios of Class A properties in the best markets. Properties that were built or renovated recently. Properties with long-term leases to investment-grade tenants. Properties that private market buyers would pay premium prices for. These REITs are trading at discounts of 30 to 40% to net asset value. That means you can buy $1 of real estate for 60 or 70 cents through the public markets. At the same time, these REITs are generating free cash flow yields of 8 to 10% at current prices. That is double what you can earn on treasury bonds. And unlike treasury bonds, where the income is fixed, REIT income grows over time as rents increase. The dividend you collect next year will be higher than the dividend this year. The year after will be higher still. You are getting paid handsomely while you wait for valuations to normalize. Why do I think this opportunity will materialize by 2027? Because the catalyst is clear. Interest rates are likely to decline over the next 2 years. As rates fall, REIT valuations will expand mechanically. Lower rates mean lower discount rates, which mean higher present values for future cash flows. The math is straightforward. Even if rates only fall 100 basis points, REIT valuations could increase 20 to 30% just from the multiple expansion. On top of that, the fundamental performance of these businesses continues to improve. Occupancy rates are stable or rising, rents are growing, earnings are increasing. As the market sees quarter after quarter of solid results, the fear will fade, investors will return to the sector, prices will normalize, and those who had the courage to buy during the panic will be rewarded. I should also mention the income component. While you wait for prices to appreciate, you are collecting substantial dividends. REITs are required to distribute at least 90% of their taxable income to shareholders. Many high-quality REITs are yielding 5 to 7% at current prices. That income provides a base return regardless of what happens to stock prices. If it takes 2 years for valuations to normalize instead of 1 year, you have collected 10 to 14% in dividends while you waited. That is not a bad consolation prize. The combination of depressed valuations, attractive income yields, improving fundamentals, and a clear catalyst makes high-quality real estate one of the most compelling opportunities I see heading into 2027. I have been building positions aggressively, and I believe patience will be rewarded with exceptional returns. The third investment I would make heading into 2027 is what I call optionality on innovation, specifically through positions in companies that are leveraged to the artificial intelligence revolution. Now, let me be clear about what I mean here. I am not talking about buying the most hyped AI stocks at any price. Some AI-related stocks are trading at valuations that assume perfection for the next decade. That is not investing. That is speculation. What I am talking about is identifying companies that have real exposure to AI growth, but are trading at valuations that do not fully reflect that potential. Let me explain why I believe AI is such a transformative opportunity. We are in the early innings of a technological revolution that will reshape every industry on the planet. AI is not just about chatbots and image generation. It is about automating cognitive work that previously required human intelligence. It is about making decisions faster and better than humans can. It is about creating entirely new products and services that were not possible before. Think about what the internet did to retail. Amazon went from a small online bookstore to one of the most valuable companies in the world. Traditional retailers that did not adapt went bankrupt. The internet created trillions of dollars of value for the companies that embraced it and destroyed trillions for the companies that did not. AI will be even more transformative. The internet changed how we buy things and access information. AI will change how we work, how we create, how we make decisions, how we discover new medicines, how we design new materials, how we manage complex systems. The productivity gains will be enormous, and the companies that enable this transformation and benefit from it will create extraordinary value. The challenge is identifying which companies will win. In the early days of any technological revolution, it is difficult to predict the ultimate winners. Many companies that look promising fail. Many companies that look irrelevant emerge as dominant players. The smartphone revolution was won by Apple, a computer company, not by Nokia, the leading mobile phone maker. My approach is to focus on the infrastructure layer, the companies that provide the picks and shovels for the AI gold rush. These companies will benefit regardless of which specific AI applications succeed, because they provide the foundational capabilities that all applications need. What does the infrastructure layer include? First, semiconductors. AI requires enormous amounts of computing power. The chips that power AI training and inference are in short supply and enormous demand. The companies that design and manufacture these chips have pricing power and growth visibility that is rare in the technology industry. Second, cloud computing. AI applications run on cloud infrastructure. The hyperscale data center operators are seeing massive demand growth from companies building and deploying AI systems. Their capital expenditure plans reveal billions of dollars flowing into AI infrastructure. This spending will translate into revenue and earnings growth for years to come. Third, data infrastructure. AI systems need data to train on and operate against. Companies that help businesses manage, process, and analyze data are seeing strong demand. The more AI proliferates, the more important data infrastructure becomes. Fourth, enterprise software companies that are embedding AI into their existing products. These companies have established customer relationships and distribution channels. By adding AI capabilities, they can increase the value they provide to customers and raise prices accordingly. They are leveraged to AI growth without the binary risk of pure-play AI companies. The key to my approach is valuation discipline. Many AI-related stocks have gotten ahead of themselves. They are priced for perfection. I am focused on the companies where the AI optionality is not fully reflected in the current stock price. Companies that have other attractive characteristics, like dominant market positions and strong cash flows, but also have significant exposure to AI growth. If AI disappoints, these stocks will still do reasonably well. If AI delivers on its promise, these stocks will do exceptionally well. That is the asymmetric risk-reward profile I look for. I should also mention the time horizon here. AI is a multi-year, likely multi-decade transformation. I do not expect to capture all the value by 2027, but I do expect to capture significant value as the AI build-out accelerates, and the market begins to appreciate which companies will benefit most. The infrastructure investments are being made right now. The revenue and earnings will follow with a lag. By 2027, we should have much more visibility into the winners and losers, and the stocks that are correctly positioned should appreciate substantially. Now, let me bring these three investments together and explain how they work as a portfolio. The first investment, large cap quality stocks with pricing power, provide stability and reliable compounding. These companies will perform well in almost any environment because their competitive advantages and pricing power protect them from economic volatility. They are the foundation of the portfolio. The second investment, high-quality real estate at distressed valuations, provides income and value. The current prices are depressed due to fear rather than fundamentals. As that fear fades, valuations will normalize and returns will be substantial. In the meantime, the dividend income provides a solid base return. The third investment, optionality on AI innovation, provides upside exposure to the most transformative technology of our generation. This is the more speculative component of the portfolio, but the positions are sized appropriately and focused on companies with attractive valuations and fundamental strengths beyond just AI exposure together. These three investments provide diversification across asset classes and return drivers while maintaining focus on quality and value. The portfolio can perform well if the economy strengthens or weakens, if inflation rises or falls, if interest rates go up or down. The investments are not correlated with each other, so the portfolio has multiple paths to success. Let me also discuss how I think about position sizing across these three investments. I am not suggesting equal weighting. The exact allocation depends on your individual circumstances, your risk tolerance, your time horizon, and your existing portfolio. But as a general framework, I think about it this way. The large cap quality stocks should be the largest allocation because they have the lowest risk and most predictable returns, maybe 40 to 50% of the portfolio. These are businesses you can own with confidence for decades. The real estate allocation can be meaningful because the opportunity is so compelling, and the downside is protected by the discount to intrinsic value, maybe 20 to 30% of the portfolio. The income yield gives you a floor return even if prices take longer to recover than expected. The AI-related positions should be the smallest allocation because they have the most uncertainty, maybe 15 to 25% of the portfolio. This is enough to capture meaningful upside if AI delivers, but not so much that it impairs the portfolio if things disappoint. I want to address some of the risks to this portfolio because no investment strategy is without risk. The first risk is that inflation reaccelerates and interest rates rise further. This would hurt both the quality stocks and the REITs in the short term. My mitigation is that the companies I own have pricing power that allows them to pass through inflation, and the REITs have fixed rate debt and growing rents that provide protection. The portfolio would likely underperform in a higher inflation scenario, but would not suffer permanent impairment. The second risk is a severe recession. If the economy falls into a deep recession, earnings would decline across all three investments, stock prices would fall, dividend cuts would be possible in real estate. My mitigation is focusing on the highest quality companies with strong balance sheets and durable demand. These companies survived previous recessions and emerged stronger. They would do so again. The third risk is that AI disappoints. The technology might not deliver on its promise as quickly as expected. The companies I have identified might not be the winners. My mitigation is keeping the AI allocation relatively modest and focusing on companies with attractive valuations and fundamental strengths beyond AI. Even if AI disappoints, these companies should perform reasonably well. The fourth risk is that I am simply wrong. I have been wrong before and I will be wrong again. Investing is a probabilistic exercise. The goal is not to be right every time, but to be right more often than wrong and to size positions appropriately, so that winners more than offset losers. My track record gives me confidence in my process, but I remain humble about the uncertainty inherent in any investment. Despite these risks, I believe the expected returns on this portfolio are attractive. The quality stocks should compound at double-digit rates. The REITs should deliver 20 to 40% total returns as valuations normalize. The AI positions could deliver even more if the thesis plays out combined. I expect this portfolio to substantially outperform cash, bonds, and passive index investments over the next 2 years. Let me share some final thoughts on execution. Knowing what to invest in is only half the battle. How you execute matters just as much. First, be patient with entries. Do not rush to buy everything at once. Build positions gradually over time. This allows you to benefit from volatility by adding at lower prices when opportunities arise. Second, be patient with the thesis. These are not trades. These are investments. They may take months or even years to play out. Do not expect immediate gratification. Trust the process and let time do its work. Third, maintain conviction through volatility. Prices will fluctuate. There will be days, weeks, even months where the portfolio goes down. This is normal. What matters is whether the fundamental thesis remains intact. If it does, stay the course. If it does not, be willing to reassess. Fourth, stay diversified within each category. Do not put all your quality stock allocation in one company. Do not put all your REIT allocation in one fund. Diversification within categories reduces idiosyncratic risk while maintaining exposure to the themes you want. Fifth, rebalance periodically. As some investments outperform and others underperform, the portfolio will drift from its target allocation. Rebalancing forces you to sell high and buy low, which improves returns over time. These are the three investments I would make heading into 2027. Large cap quality stocks with pricing power, high quality real estate at distressed valuations, and optionality on AI innovation through carefully selected infrastructure and enterprise software positions together. They form a portfolio that can generate attractive returns across a range of scenarios, while providing downside protection through quality and value orientation. The next 2 years will be full of uncertainty. Headlines will scream about whatever crisis dominates the news cycle. Markets will fluctuate. Emotions will run high. But investors who maintain discipline, who focus on fundamentals, who buy quality at reasonable prices, will be rewarded. That has always been true, and it will be true heading into 2027. I have positioned my capital accordingly, and I am confident that when we look back from 2027, this will prove to have been an excellent time to invest in these three areas. The opportunities are clear, the valuations are attractive, the catalysts are in place. All that remains is having the courage to act and the patience to let the thesis play out. Let me elaborate on some of the specific dynamics I am watching that reinforce my conviction in these three investments. For the large cap quality stocks, I am paying close attention to earnings reports and pricing trends. Every quarter, I analyze whether these companies are successfully raising prices and maintaining margins. So far, the evidence is overwhelming. The best companies are passing through cost increases to customers while maintaining or growing volumes. Their earnings power is actually increasing in this inflationary environment, which is exactly what you want to see from businesses with true pricing power. I am also watching the competitive dynamics closely. In any industry, periods of economic stress tend to separate the strong from the weak. The companies with dominant market positions and strong balance sheets can invest through the cycle. They can acquire struggling competitors at attractive prices. They can take market share from weaker players who are cutting back on marketing research and customer service. By the time the economy fully recovers, the strong will be even stronger and the weak will have faded away. This is why buying quality during periods of uncertainty is so powerful. You are not just buying current earnings. You are buying the ability to emerge from this period with an even better competitive position. For real estate, I am monitoring several leading indicators that will signal when the sector is ready to turn. First, I watch private market transaction activity. When institutional buyers start acquiring properties at current valuations, it validates that public market prices are disconnected from reality. We are starting to see early signs of this, with sophisticated buyers picking up trophy assets at prices well above implied public market valuations. Second, I watch credit spreads in the commercial mortgage market. When spreads tighten, it indicates that lenders are becoming more comfortable with real estate risk. This improves refinancing conditions and removes one of the major overhangs on the sector. Spreads have stabilized and are beginning to improve in certain property types. Third, I watch sentiment surveys and fund flows. Real estate remains deeply unpopular with investors. Funds are experiencing outflows. Analyst ratings are negative. This contrarian indicator suggests we are closer to a bottom than a top. When everyone who wants to sell has sold, there is no one left to push prices lower. For the AI-related investments, I am tracking the pace of enterprise adoption. The consumer applications of AI have gotten all the attention, but the real money will be made in enterprise deployments. When I see large companies announcing major AI initiatives, increasing their technology budgets, and hiring AI talent at a rapid pace, it tells me the demand is real and accelerating. The infrastructure investments being made today will translate into revenue and earnings growth for the companies I own over the next several years. I am also watching the competitive dynamics among AI infrastructure providers. Some companies are pulling ahead with superior products and deeper customer relationships. Others are falling behind. By carefully analyzing which companies are winning and which are losing, I can position the portfolio to capture the upside while avoiding the companies that will disappoint. Let me also share some thoughts on the macroeconomic backdrop and how it influences my investment thesis. We are in a period of transition. The era of zero interest rates and quantitative easing is over. The era of globalization and deflationary supply shocks is ending. We are entering a new regime characterized by higher structural inflation, more volatile interest rates, and greater geopolitical uncertainty. This new regime favors certain types of investments over others. It favors real assets over financial assets. It favors pricing power over growth at any price. It favors quality over speculation. The three investments I have outlined are all positioned to benefit from this new regime. The quality stocks have pricing power. The real estate provides real asset exposure. The AI investments are focused on companies with fundamental strengths beyond just growth narratives. I also believe we are approaching a period of relative calm after several years of extreme volatility. The pandemic shock, the inflation surge, the interest rate hiking cycle, all of these dislocations are now behind us. Markets are beginning to normalize. Valuations are becoming more rational. Investors are returning to fundamental analysis rather than momentum chasing. This is the environment where quality and value investing tends to outperform. I do not want to suggest that the next 2 years will be smooth. There will be volatility, there will be unexpected events, there will be periods of fear and periods of greed, but the underlying trend is toward normalization, and that benefits the types of investments I have outlined. Let me discuss one more important topic, which is the psychological challenge of implementing this strategy. I have found that the biggest obstacle to investment success is not analytical, it is emotional. Most investors know what they should do. They should buy quality at reasonable prices. They should be patient. They should avoid speculation. But knowing what to do and actually doing it are very different things. The challenge is that the best investments often feel uncomfortable. Buying quality stocks when the market is worried about recession feels scary. Buying real estate when headlines scream about commercial real estate collapse feels reckless. Buying AI infrastructure when valuations seem stretched feels foolish. The instinct is to wait for things to feel safer before investing. But waiting for things to feel safer means waiting for prices to rise. By the time the recession fears fade, the quality stocks will have already rallied. By the time the commercial real estate headlines turn positive, the REITs will have already recovered. By the time AI adoption is obvious to everyone, the infrastructure stocks will be expensive. You have to buy when it is uncomfortable, because that is when the prices are attractive. I have trained myself over decades to overcome these emotional obstacles. I focus on fundamentals rather than feelings. I ask myself whether the investment thesis is sound, whether the valuation is attractive, whether the risk-reward is asymmetric. If the answer to those questions is yes, I invest regardless of how it feels. This discipline has served me well. Some of my best investments felt terrible when I made them. I was buying into fear and uncertainty, but the fundamentals were sound, the valuations were attractive, and the eventual returns were exceptional. The worst investments I see are the ones that feel great at the time, buying into euphoria and consensus. Those investments often lead to disappointment. So as you consider these three investments, check your emotions. If they feel uncomfortable, that might actually be a good sign. It might mean you are buying at attractive prices when others are fearful. The discomfort is the price you pay for potential outperformance. Let me also address the question of timing. Some investors wonder whether they should wait for even better prices. Maybe the quality stocks will get cheaper. Maybe the REITs will fall further. Maybe the AI stocks will have another correction. It is possible. I cannot predict short-term price movements. No one can. But here is what I know. The current prices are attractive. The expected returns from current levels are compelling. Waiting for even better prices might mean waiting forever. Markets do not always cooperate with our desire for perfect entry points. The stocks you are waiting to buy might rally instead of falling. Then you are left watching from the sidelines as your thesis plays out without you. My approach is to invest when prices are attractive, not when prices are perfect. I accept that I will rarely buy at the absolute bottom, but I also accept that buying at attractive prices is far better than not buying at all. The enemy of good is perfect. Do not let the pursuit of the perfect entry point prevent you from making good investments at attractive prices. The three investments I have outlined today: large cap quality stocks with pricing power, high quality real estate at distressed valuations, and optionality on AI innovation, represent my highest conviction ideas heading into 2027. I have analyzed countless opportunities over the past year. I have rejected dozens of ideas that did not meet my criteria. These three categories rose to the top because they combine quality, value, and catalysts in ways that other opportunities do not. I cannot guarantee that these investments will work out exactly as I expect. Investing involves uncertainty. Things can go wrong. Theses can fail to materialize. But I am confident that the probabilities favor success. The quality of the businesses is evident. The valuations are attractive by historical standards. The catalysts are clearly identifiable. These are the ingredients for successful investing, and they are all present in these three ideas. The next 2 years will determine whether I am right. I am prepared to hold through volatility, to add to positions if prices decline further, to let the thesis play out over time. I am not looking for quick profits. I am looking for substantial wealth creation through the disciplined application of investment principles that have worked for decades. That is the opportunity I see heading into 2027. 3 investments: quality, value, and catalysts. The rest is patience and discipline.